Hello everyone, my name is Lamar Baxter. I'm with AccuPlan Benefit Services. I'd like to thank everyone for joining today's webinar. Today's topic, we're going to be covering investing in trust deeds with your self-directed IRA and 401k. Today's guest speaker is going to be from an organization called Calliance Realty Fund, LLC. The actual presenters for that organization will be Roesner and Dennis Konczal. What we're going to be covering today is the following topics. We're going to be covering investing in private notes and funds, risk and rationale of bridge and private real estate loans, real estate debt investment options, also referred to as deeds or deeds of trust and mortgage notes, mortgage bonds, debentures, investment options, and what we're going to be talking about relative to the self-directed plan is what is a self-directed plan, the different types of accounts that's available to you, the IRS rules will make sure that you're compliant as it relates to using a self-directed plan as it relates to real estate or other types of investment. We'll talk about the plan types and investment types and options and structures. Before we get started, just kind of want to give you a little housekeeping rules. We're going to be recording this webinar, so in the event that you are able to pass this information along to other parties who were not able to attend, we'll have the playback link to be sent out within the next 2 to 3 business days. And we urge you to, once again, to listen at your leisure as well as to pass along to others who may be interested in the topics that we're going to be covering today. And once again, one of the things we will do, always offer information via education. Our objective is not to give you any advice or steer you towards any type of investment. It's primarily education to pretty much alert you what type of investment options you have using the self-directed plan. So with that being said, our disclaimer basically states that you want to make sure that you consult with your financial planner, investment advisor, and obtain any type of legal consultation prior to entering into any type of investment. Once again, we're not promoting or endorsing any particular investment opportunity. We're pretty much just outlining and educating you in terms of what's out there and what the structure are for the different types of investment options that's available to you. We will open up for a Q&A session towards the last 10 minutes of the call. So what will happen is, starting off, we'll have the gentleman from Calliance Fund to start their presentation, and then we'll go over to talk about the self-directed plan, and then we'll allow you to answer send in any questions you may have relative to what was covered via the chat feature. Any information or questions we cannot cover within that last 10 minutes, feel free to give us a call and or send us an email. We'll be happy to answer any questions you may have. So with that being said, I'm going to go ahead and turn this over to Calliance.
Thanks, Lamar. This is Russell Roesner from Calliance, and I'm here with Dennis Konczal. Lamar, just a quick question for you. We don't see our slides. We see yours, but we don't see our own.
There may be a delay. Hold on here.
Yeah, we just see the AccuPlan. There we are. Very good.
Okay.
Thank you very much. So please advance to the next slide.
Okay, next slide. We have a slight delay here. I'll catch up in just a second here. Okay.
Well, in the meantime, I just wanted to, first of all, thank you for setting this up for us today, Lamar. You know, an investor's success is due in part to the financial advisors who introduce them and educate them about products and alternative investments, and we're really happy to be one of those potential investment options for your clients, and we're hoping that we can bring some good information to your clients out there regarding deeds of trust and the various options that people typically are able to, utilize to make these investments. So next slide, please. So to start off, let's talk about what we're going to be going over today. First of all, we're going to explain what a real estate deed of trust actually is for those of you that don't know. We're going to go over the rationale for bridge or private loans. As many of you may know, typical private loans or bridge loans are a premium interest rate, and we're going to try to go over reasons as to why borrowers would pay such a premium given that we're at all-time lows with bank rates. We're going to go over properly structured deeds of trust as we define them. We're going to go over deed of trust investment options. And finally, we're going to go over mortgage bonds and debenture enhancements, and we'll talk about that a little bit later at the end of the presentation. Next slide. So, a deed of trust defined. A deed of trust is a written document legally conveying real estate to a trustee to secure a promissory note. The deed of trust is recorded in the county where the real estate is located. Investing in a deed of trust is simply making a loan to a borrower secured by their real estate. Typically, these loans are made by banks, or they can be made by individual investors, retirement plans, or other entities like pension plans and so forth. Next slide. A properly structured deed of trust is suitable for an IRA or for a direct investment. Generally, will generate monthly income between 5.5% and 11% annually. There are multiple characteristics which are designed to create safety of principal, the loan amount, and these types of loans are often referred to as bridge, private, or hard money loans. So, as I had mentioned before, why would a borrower pay up to 11% interest when interest rates are at an all-time low? Advance. Next slide. Well, to start off with, a property may not qualify at a normal bank because of its condition. The property needs a new roof or a foundation, or maybe the property hasn't been completely finished. It may be in the middle of construction. There are many reasons why a property might not actually qualify at a regular bank. Another reason is that right now, federal guidelines dictate that a borrower cannot make more than 10 bank loans at any given time. So if you are a professional investor and you own more than 10 properties, you cannot borrow from the banks and you have to go elsewhere. Another reason is the borrower can't wait for a typical bank loan to close. These days, it takes 45, 60 days, even longer for a bank to actually fund a loan. And there are many investors out there and folks who can typically get a good deal on a property if they can close quickly. And private lenders come in and help people do that all the time. Another reason is a borrower wants to borrow through a business entity, such as an LLC, a trust, or a corporation. Banks typically do not lend to anyone except for individuals, and they do not lend to businesses. Another reason is a borrower may have had a strategic default that affects their credit. And finally, a borrower may be self-employed. For those of you that are self-employed, you know how difficult it can be to borrow money from banks because people that are self-employed typically write off a lot of their expenses. And it's very difficult to determine someone's actual income if they are self-employed. So there's a common misconception that all loans using bridge or private financing are risky. But a properly structured deed of trust doesn't have to be risky. As we explained before, there are many legitimate reasons why a borrower might use private or bridge financing instead of bank money. So let's give you an example. Next. Could you go back a slide, please? Okay, well then let's go to the next slide. Sorry. So let's go over some of the ways that private lenders are able to actually create more safety of principal when they're making their loans from the standpoint of underwriting guidelines and strategies. So to start off with, one of the main ways private lenders are able to mitigate risk is through implementing something called loan-to-value. Loan-to-value is simply the loan amount divided by the actual property value. So the lower the loan-to-value, the more equity there is in a property to protect the principal. And most private lenders do not lend more than 70 to 75% above what their, or above the actual loan-to-value. Next slide. So today, for a properly structured deed of trust, we are valuing our properties based on the current market environment. So basically, we don't need to have the market fluctuate or change or appreciate for our investors to actually get the kinds of returns that they're expecting. And if you look at the typical California median home prices, they did fluctuate wildly over the past 6 or 7 years, but now they've stabilized. So we would like to put forward that it's probably a pretty good time to be investing in deeds of trust because a stable market environment provides for quite a bit of safety. Next slide. A few more best practices the private lenders implement are designed through underwriting guidelines and risk mitigating strategies. So, for instance, most people that do deeds of trust, or most lenders that do deeds of trust, do loans on income-producing properties. The reason why that's a benefit is that if you make a loan on an income-producing property and you're having trouble getting your mortgage payments from your borrower, you can always take the property's actual rental income and still get your payments made. Another reason, or another angle, is that the loan amount is typically at or below the property's replacement cost. Due to the market drop in the last 5 or 6 years, we are actually able to make loans these days at or below the actual replacement cost for properties. Another reason is that each loan must have a definitive exit strategy of property sale or refinance. What that means simply is this. When we make a loan, we always make sure that there's some way of getting actually paid back at the end. So for instance, we want to guarantee that our borrower is going to be able to either refinance or sell the property, and we will never make a loan without a clear exit strategy. And finally, the loans are secured in first position. Being in first position is always a much better place to be than in second position or third position, because you can go ahead and take that property back much easier. Finally, there's a few other strategies we use. Loans have maturities of less than 5 years. That way, we're able to capture any interest rate changes. So if interest rates go up and we want to start charging higher interest rates, we want to make sure that our loans actually mature and pay off so we can raise our interest rates on new borrowers. Another angle is that the borrower's experience and ability to pay has to be really carefully evaluated. Just because one is in the bridge lending market doesn't mean that they don't actually underwrite and look at borrowers carefully to make sure that they're able to make monthly payments and they're solid citizens. Another is that originator of the loan has a specific geographic focus. It's important when you're in the bridge lending business to know your market. So, for instance, our company is located in Northern California, and we primarily only make loans in our own backyard because this is the market that we know the best. Our loans are professionally serviced, and finally, this is something that a lot of our clients don't really understand, which is that private lenders, in many cases, are more conservative in regard to their underwriting guidelines than the banks are. Next slide. So let's compare bridge loans versus bank loans. To start off with, interest rate. Banks charge a much lower rate, 3.5%, 4.5%, and bridge lenders charge something between 5 3/4 and 11% interest, or maybe even more. The closing time is very quick for bridge loans, and banks take 45 to 60 days to close. Bridge lenders are able to make loans on all types of properties, commercial properties, so retail centers and warehouses and industrial properties, as well as residential 1 to 4s, where banks typically focus only on owner-occupied residential single-family homes. The property condition can be in good or bad when it comes to bridge lending, and the banks are very focused on properties that are in move-in condition and don't need to be renovated. The maturity of the loans are very short for bridge lenders, 12 to 36 months. Banks can go from 30 to 40 years. For bridge lenders, the borrower's credit is typically evaluated case by case, where the banks are very rigid and FICO score driven. And finally, bridge lenders can lend on all types of borrowing entities, such as businesses, where the banks focus only on individuals. So let's go over the deed of trust investment options. And I'm going to pass the presentation over to Dennis Konczal, who's the president of Capital Alliance, and he's going to take us on through to the end. So without further ado, please, Dennis, begin.
Thank you, Russell, and thank you, Lamar and AccuPlan, for giving us this opportunity to present today. As I see it, there are basically 3 different ways to invest in deeds of trust. One of them is investing in an individual deed of trust. So you would be, as an investor, would be owning a whole loan. If it's let's say it's a $100,000 loan, you would own $100,000 of it. You would own 100% of it. Or in some cases, you can own a fractionalized interest in that loan, maybe 33% of that loan in conjunction with one or two other investors that may own the other 66%. So one way of investing is to acquire an individual deed of trust on an individual property. A second way of investing in deeds of trust is through a mortgage pool, and this is basically either generally a limited liability company or a partnership that collects capital from investors and then turns around and takes that capital and uses it to fund a pool of mortgage loans or deeds secured by deeds of trust. Another option, which is really kind of interesting, I think, is a mortgage bond or debenture. It could be called a debenture. The bond itself is issued by the company, the LLC or the partnership, and it is secured by very specific loans that back that bond. And so the security for a mortgage bond would be the individual loans that are backing it, as well as the equity of the company itself, since it's issued by the LLC or partnership. So it is senior to the company's equity and other unsecured debts of the company. So it's a little bit of a hybrid structure. We're going to go into the differences here in a moment. So next slide, please. So let's compare, first of all, individual deeds of trust to a mortgage pool. And typically, individual deeds of trust are going to give you the highest return. We think, normally in today's market, you're looking at somewhere between 8 and 11% per annum. But since you get a higher return, obviously, you probably would surmise that there's higher risk associated with that. And what is the higher risk? Well, the higher risk is that if you own an individual deed of trust, you don't have any diversification. It's typically one loan to one borrower, and it's a loan typically on a single property. And if that loan defaults for whatever reason, obviously the income that you're expecting to generate from that deed of trust would stop until that situation gets resolved. The other thing is a minimum investment. Since we're talking about individual deeds of trust in California, there are not a whole lot of individual $100,000 first trust deeds in California. Typically, first trust deeds in California and today, particularly in the Bay Area, could be $300,000 to $300,000 to some pretty large number. So the minimum investment is typically $100,000 or more, and the way that you would invest in an individual deed of trust in that regard would be through a fractionalized interest in investing with other investors. The liquidity of your investment would be based upon when that loan pays off. So most individual deeds of trust, though, are pretty short-term, generally 12 to 36 months. So that would be the liquidity of the payoff of the loan. Since you own that loan and the borrower is paying you interest, somebody needs to prepare for the borrower 1099 at the end of each year to make sure that it's reported properly from income tax purposes. And then finally, you put in 100% of the capital to own the loan, and it's not in a leverage situation. Let's compare that to a mortgage pool. Typically, the returns are a little bit lower, let's say 5 3/4 to 8%. But the difference is the risk profile. You're talking about now a diversified investment. You're talking about multiple properties and multiple borrowers. If you have a situation where one of the borrowers decides not to pay on his loan or defaults, if the pool is properly diversified, and then you're looking at the other loans and the other properties in the pool, in essence, to make sure that you get a continuous payment. Typically, the minimum investment is a lot lower as well because you are acquiring a partnership interest. And so the typical minimum investments could be $25,000 or in some cases even lower. Liquidity is an issue, though. In most cases, if you invest in an LLC or a partnership, there are liquidity provisions, redemption provisions, and so on, but typically those don't kick in for a period of time, in most cases at least 5 years in the situations that we've seen. Since it is a partnership or an LLC, typically you're going to get a K-1 each year, which will come hopefully sometime by the end of the first quarter. and the sponsor of the mortgage pool could leverage that pool. In other words, he could take your capital and use it to borrow additional money and to acquire additional loans. So it may be leveraged. Now, next slide, please. So let's compare a mortgage pool to a mortgage bond. Well, first of all, the first three characteristics are pretty similar. The returns are typically similar for both vehicles. They both, if it's a mortgage bond that's big enough, it will be secured by a diversified set of investments, multiple loans, multiple properties, multiple borrowers. Typically, the minimum investments are about the same, $25,000 or so. But what are the enhancements? Since you are investing in a bond that's issued by a company, your interest income that you receive as an investor will be reported on a 1099 and not on a K-1. Since you are investing in a bond, this won't be leveraged. It is not going to be a leveraged investment. Liquidity can be structured depending upon what maturity you buy. For instance, you could buy, we've seen bonds that are structured with 3-year maturities, or we've seen bonds that are structured with 5-year maturities. So if you buy a blended set of maturities, or laddering as it's called, you can set your liquidity based upon the maturities that you buy. Now, the other thing that's kind of interesting, some bonds can be structured in a way that they're over-collateralized, and I will touch on that in a second. Also, the notes and deeds of trust that secure that bond, if it's a secured bond, are typically held by an independent third-party custodian. You know, AccuPlan is a custodian. They could hold the notes and deeds of trust. But a third party would be holding those individual notes and deeds of trust that secure that bond. And if the bond is structured as a senior secured bond, it will be, the investor would be in a preferred position. In other words, he would get paid before any equity holders got paid of the issuer or any unsecured debt. And the word secured means that it is secured by a specific set of notes and deeds of trust. Okay, he's already gone to the next slide. That's good. You're ahead of me, Lamar. All right, so let me talk about this concept of over-collateralization. One that we've seen that we think is kind of interesting is that it is at all times the total unpaid principal balance of the deeds of trust securing the bond will be at least 10% greater than the bond outstanding. So what does that mean exactly? Well, let's look at it this way. If you look at the chart on the far right, the column on the far right, assume that you invested invested in a $100,000 mortgage bond. The particular one that I'm referring to, at March 31st, there was $128,760 of outstanding unpaid principal balance securing each $100,000 bond. So, and the weighted average loan to value of that unpaid principal balance was 66%, 66.14%. Now, what that means is if you take the outstanding principal balance and divide it by the loan to value, that means that there was market value of property, $194,000 of property value securing each $100,000 debenture. So effectively, the $100,000 debenture has an effective loan to value of about 51.4%. So there are bonds structured out there that are over collateralized. So it adds a tremendous tier of safety to the investment itself, as opposed to a mortgage pool where you would have $100,000 in investment and you would have $100,000 of mortgage notes receivable securing that investment. There are other enhancements, as we talked about. Next slide, please. Next slide, please. There are other enhancements. Again, the actual security that would be backing the bond is typically held by a third-party agent or third-party custodian. So the deeds of trust are segregated from the other assets of the issuer, and that third-party custodian, if there is a over-collateralization provision that we just discussed, would monitor that provision as well. The bond can be designed as a senior secured bond, which means that the bondholders would get paid before any subordinated debt or the equity holders of the issuers. So they would be in a senior secured position. And so the bond is not only backed by the deeds of trust themselves, the over-collateralized nature of the deeds of trust, but also by the creditworthiness of the issuer. So you have multiple layers of safety, and those deeds of trust, like I said, are also held by a third-party custodian. So next slide, please. Next slide, please. So to summarize the enhancements of bonds over a mortgage pool, you have up to 8% annual interest with income paid monthly. The bondholders can be in a senior secured position. The bonds can be over collateralized. There are varying maturities that can provide liquidity. We're not dependent upon a property sale or a refinance to cover the redemption of the bond when the time comes. And you're looking at 1099 reporting instead of K1 reporting. Next slide, please. So in summary, investing in real estate loans within your IRA or 401k can be a higher yield investment alternative to other fixed income type investments like CDs, money market accounts. That's pretty obvious. Even a lot of bond funds. I mean, a lot of people will use individual trust deeds, mortgage pools, or mortgage bonds to generate a return as part of their fixed income allocation within their portfolio. So we think that is something that every investor should take a look at if they've got a fixed income portion of their portfolio that they're trying to maximize the returns on. There's going to always be a need for the private loans that we've talked about here, because banks will often disqualify a borrower for crazy reasons or take it for too much time in order to complete a loan application. Properly structured deeds of trust provide reasonably high income and can be designed so that there's a preservation of capital. And as we've gone over, there are 3 types of investment vehicles that you can invest in, and we can help you decide which one is right for you. So let me go to the next slide, please. Just talk a little bit about my company, our company, Calliance Advisors. We can provide investors with individual deeds of trust, mortgage pools, mortgage bonds, etc. We've been in business since 1991 in the state of California. We've funded collectively over $1.5 billion of residential loans. At least that was the last time we counted. It's a greater number than that now, but it's a big enough number. We've acquired for ourselves and others over $500 million in investment property. We have advised 7 different public real estate investment trusts. Our management team really is led by myself and Russell, along with Bill Aubrey, who's our Chief Investment Officer. Bill has been in the mortgage business for over 20 years, and he has underwritten about $500 million of residential paper. So collectively, we think that if you're interested in making an investment, a real estate investment in deeds of trust as a fixed income alternative or as your real estate investment, we would be in a position to help you out from a couple different directions. And so we thank you for your time and thank Lamarr and AccuPlan for sponsoring this. And we would, I guess, at this point, Lamarr, open it up for questions.
No, Lamarr.
Actually, we'll do the Q&A towards the very end. And actually, this is a great presentation. I know a lot of clients as well as prospects who are kind of on the fence deciding as to whether they want to establish a self-directed plan for alternative investing. And not everyone has the time and or the expertise to invest directly in real estate. So this is an excellent option when it comes to real estate investing to take more of a passive approach to be able to invest in real estate through deeds of trust. And towards the very end, I'll give you a checklist of what's required to make this type of investment. I know real estate is one of the #1 asset classes that are used by those with self-directed plans. And I know the private note and the trust deed investment industry is on the rise as a result of the popularity. And then also because the market is hot and it's so competitive to where some have a problem entering the market. So the next best option, and in a passive option, is to invest in deeds of trust. So what I'm going to do is switch over to my slides, and we're going to talk about the self-directed plan and what is a self-directed plan, the different options, and the different plans that's available to you depending on whether you're employed or self-employed. Of course, what we want to do is really just kind of give you a brief overview in terms of what a self-directed plan is, what your investment options are. We'll talk a little bit about some of the rules that you must follow on any type of investment. For those who joined the webinar late, my name is Lamar Baxter. I'm the Director of Business Development, located here in Sacramento, and actually cover all of Northern California. So I'm usually doing a lot of webinars as well as live presentations covering the different aspects of real estate investing as well as other alternative investments using the self-directed plan. A little bit about AccuPlan. We've been in business since over the last 16 years. We were previously owned by another company called North American Financial Planners Association, and they basically combined, and basically we're broken up into two parts, which is American Estate and Trust, which is our parent company and custodian, and AccuPlan, which is the administrative division, which basically take care of all the IRS reporting and record keeping. Before we get started, I want to also reiterate our disclaimer indicating that we are providing information today, primarily educational information. Any information today should be relied upon us as education. If you require any type of tax and or legal advice to aid you in making a decision on this or any other type of investment, please do consult with them. As I mentioned, we're a national company specializing in self-directed IRAs and 401ks. We provide both custodial and administrative services. We pride ourselves on our expertise as well as our low-cost structure and quick service for the self-directed plans. Our staff is made up of a compilation of financial professionals and those also who are formerly with the IRS. So we're trying to make sure that we have a staff that's going to make sure you have the most up-to-date knowledge when it comes to these types of plans, as well as to make sure that all your transactions are compliant. So before we get started, some of the more common questions that usually will come up is why a self-directed plan? And these bullets here will pretty much outline why more of investors or retirement account holders are looking to the self-directed plan to truly diversify their investment portfolio as it relates to their retirement income. So it's estimated that 10,000 baby boomers per day will turn 65 for the next 20 years. Of that segment of the population, up to 75% of that population do not have the resources to retire beyond the age of 65. And if they're lucky to be able to work beyond the age of 65, depending on their occupation and their capacity, that's not always going to be available to the general population. So it's really important that you take a proactive approach at looking at your retirement plan and your products to make sure that you're in a good position to be able to retire comfortably and to be able to have a diverse investment portfolio that's going to continue to grow as you go into your golden years. Most will be forced to continue to work beyond the age of 65, faced with the retirees facing skyrocketing healthcare costs, diminished Social Security benefits. A lot of the benefits that our parents and grandparents that we're able to take advantage of may not be there for most of us in the next 10 or 15 years. Inflation and cost of living increases will threaten to erode any fixed income that one would usually receive from retirement income. It is estimated that $4.7 trillion in combined IRA and 401k funds are out there, and only 1% of that $4.7 trillion are invested in self-directed plans and or alternative investments. So we definitely need to get that 1% number up to be able to really have a chance at having access to every investment option that's available to us. It is estimated up to 90% of the population is unaware of what a self-directed plan is. And that would also include your attorneys and your accountants, your financial planners and advisors, as well as some of your other custodians. In fact, you may have heard of the term self-directed retirement plan, but it's a generic term. A truly self-directed plan will allow you to invest in any and everything with the exception of life insurance and collectibles. So if you currently under the impression that you have a self-directed plan, you want to basically contact your plan administrator or custodian and find out what your investment options are. And the true measuring stick as to whether you have a true self-directed plan is your ability to invest in any and everything with the exception of life insurance and collectibles. Diversification will always be key. As I mentioned, $4.7 trillion in retirement assets, and most are invested in traditional Wall Street types of investments. The majority of the funds are invested in some of your investment vehicles such as stocks, bonds, mutual funds, and so on and so forth. And once again, only 1% of that will basically comprise or make up the alternative investment pool. Our motto in the self-directed IRA industry is invest in what you know and understand. I'd like to believe that the general public have some type of expertise or niche when it comes to different investment options. These are some of the more common transactions that have come across my desk over the last 8 years that I've been in the industry. Real estate, as I mentioned earlier, is the #1 asset class, whether it be residential, commercial, land, as well as international real estate. Precious metals is one of those options that's available to you with the self-directed plan if you're looking to, once again, to truly diversify your investment portfolio. But once again, you want to maybe consult with your investment plan or advisor to see what portion or percentage of the mix of your portfolio should consist of precious metals. Private notes and loans, as Dennis and Russell just finished talking about trust deeds and private notes and loans. That is an emerging industry, or should I say segment of the alternative investment pool, where people are actually loaning money secured by real estate, personal properties, and even a UCC1. Yes, you're able to loan monies both secured as well as unsecured. Not something that we highly recommend, but it is an option to loan monies unsecured. You definitely want to do your due diligence on any type of investment, in particular when it comes to private notes and loans. You want to sit down with experts such as Calliance, such as Dennis and Russell, to basically walk you through what your options are. Then, of course, to do your additional due diligence on the investment and make sure that the numbers are going to work for you. Private notes and, I should say, private companies, that is an emerging area as well. There's a lot of institutions out there that will not loan to start up business or basically fund capital to start up business. So using a self-directed plan, you're able to invest into small business, whether it be starting and or existing businesses. And the structure, you have a lot of different variations in terms of how you want to structure that transaction that's available to you as well. So when you talk about a self-directed plan, this is what you usually want to take a look at. Hopefully this list will pretty much open your mind in terms of what options you have available to you. And I'm sure if you were to contact your current retirement plan or custodian as to whether you have options to invest in these different types of asset classes, I'm sure the answer would be no. As I mentioned, trust deeds and mortgage notes is a passive way to be able to invest in real estate. And if you're not experienced in terms of basically making or granting a loan secured by a piece of real estate, because there are other responsibilities that you would have to take on if you don't have the background and or experience. That's why a lot of our clients are also looking to work with organizations such as Calliance, because they have an infrastructure in place that will basically have them take care, and a staff that will take care of basically making sure the borrower has been vetted, as well as making sure that everything is secured against the property, payments are received in a timely manner, so on and so forth. So if you're not in a position to become, should I say, a loan officer as well as a loan servicer, you definitely want to maybe look at a structured investment option when it comes to, or should I say, structured investment pool, such as what Calliance offers, as well as maybe even working with them on some of the individual deeds of trust as well. Prohibited transactions. As I mentioned, your only limitations are you cannot invest in life insurance and or collectibles. Also part of IRS Code 4975 is that you cannot engage indirectly or indirectly with anyone or anything considered prohibited or disqualified. So for example, prohibited transactions are considered between two disqualified persons in the IRA. And some of the activities, if related to disqualified parties, would be considered as selling or exchanging or leasing property, lending money, extending credit. Some of the options that you do have available to you, as long as the party that your IRA or 401k is doing business with is not a quote-unquote disqualified person. And on the next slide, we'll talk about who's considered a disqualified party or disqualified person to kind of give you a clear idea in terms of who you can and cannot work with. So what you want to make sure, in addition to following these guidelines, is to keep in mind no self-dealing and no personal use of the assets acquired by the real estate, or should I say by the self-directed plan. So here is a list of disqualified persons, and once again, it's not just limited to the family members, it's also limited to other parties and entities as well. So for starters, you and your spouse are considered disqualified parties, meaning that you cannot do business with your IRA between yourself and your IRA, or between your IRA and your spouse. Other parties that's prohibited or considered disqualified parties are your children, your children and grandchildren, parents and grandparents, and so on and so forth. So anyone who's considered lineal ascendants and lineal descendants are considered disqualified parties. So keep in mind that you're not disqualified from working with all family members. So for example, if you have a brother or sister or aunt or an uncle, someone who's not considered lineal or an ascendant or a descendant, you're able to work with that party or parties in terms of putting together a transaction that may consist of working with those other parties or family members. Any fiduciary to the IRA is also prohibited. So if you're a real estate professional, attorney, or CPA engaged directly in the transaction that the IRA is going to be involved in, you cannot partner with that IRA to be able to do a deal or to do a transaction. You can perform your fiduciary capacity as long as your funds are not directly or indirectly involved in a transaction where you're representing the client or the account holder of the IRA or 401k. Anyone providing services to the IRA. I may have not mentioned towards the very beginning, unlike some of your other financial professionals, this is something that I truly believe in. I actually practice what I preach. I actually have a self-directed SEP IRA as well as a self-directed 401k, Roth 401k. And what I actually do is loan money secured by first and second deeds of trust. I've been doing it for the last 15, 16 years, as well as using my retirement funds. I use personal funds, but because of my background, this is something that I have time for, and it's more of a, like I said, passive approach for me. And I've been, like I said, been doing this for a while and able to add some insight on how this process works and also the credibility and ability of this type of investment structure. Corporations and partnerships and trusts are also considered, if you own at least 50% or more, you're also prohibited from doing business with a corporation or partnership where you and or your spouse own more than 50% ownership. Now, if you own less than 50% of that entity between both you and your spouse, you are able to do business, but you also want to keep in mind that in addition to the 50% threshold, you cannot have controlling interest in that organization. So if you're going to be doing a transaction with the corporation or entity that you already have existing ownership, you want to make sure that you're not signing off on the documents relative to the entity or the corporation, and also between yourself and your spouse that you two combined do not own more than 50% within that entity to allow you to be able to do business with your plan. So in essence, here's in summary, you do not want to mess with the IRS. This is a very popular investment vehicle. The IRS is paying close attention to this investment vehicle because there are abuses based on the various types of structures for those who are looking to evade or not pay taxes. So they are taking a closer look. So you want to make sure that you are following the rules to make sure your transactions remain compliant and that your plan is not disqualified, taxed, and penalized. So in order to get your account set up, you basically would go online to, which we usually provide an online application or a PDF application. Usually you can get the account set up within the first 24 hours. Once the account's established, you want to get your account funded. And these are some of your methods of getting the account funded. Transferring funds from another IRA, usually an IRA to IRA transfer, usually it's a 7 to 10 business day process from the time that your existing custodian received the request, and either they will cut a check or wire the funds to your new plan. A rollover is usually consisting of or usually involving an employer-sponsored plan such as a 401k or other retirement plan by an employer such as a 403b, 457, where you're going to be rolling over the funds, not transferring. And usually you have 60 days, whether it's a direct or indirect rollover, to make sure when those funds depart from your 401k or employer-sponsored plan that they are received by the receiving custodian within 60 days to avoid a distribution or tax and penalty for not getting those funds to another retirement custodian within 60 days. The process also takes anywhere from 7 to 10 business days, but it could be shorter. You definitely want to consult with your current custodian in terms of what their turn times are. The turn times of 7 to 10 business days is the standard, but of course it could be longer or it could be shorter. Contribution, that's going to be relative to the plan that you're either going to be selecting or eligible for. And based on the type of plan that you will be selecting, you have contribution limits where you're able to contribute funds from your pocket on an annual basis into the plan in addition to being able to transfer or roll over funds from another retirement plan. And we'll talk about the contribution limits on the next page when we talk about the different types of plans. Conversion, for those who are looking to move funds from a tax-deferred account over to a tax-free account from, for example, a 401k to a Roth, or from a traditional IRA or SEP IRA to a Roth, you basically are allowed to convert those funds, pay the taxes, of course, on whatever the amount you're going to be converting, whether it be all of the funds or a portion, and then you are going to move the funds over into a Roth IRA. And we'll talk about what the benefits of the Roth IRA is on the next slide when we talk about the different types of plans. Those options are available to you in terms of funding your retirement plan. If you have any additional questions, I'd be happy to answer any detailed questions you may have relative to your specific scenario. So here are the different types of plans. All of our plans are self-directed, but these are the different plan types that are self-directed. So some of these plan types are probably familiar to you. These are plans that are already out there. The only difference between our plan types as opposed to some of your traditional types is that you have the ability to invest in alternative investments. All the rules relative to contributions and so on and so forth are the same as any other retirement plan out there. We follow the same rules as the plans that you have out there currently. So looking at the traditional IRA, it is a tax-deferred account where you're able to contribute up to $5,500 per year if you're under the age of 50 and a half. If you're over age of 50 and a half, you can contribute an additional $1,000, totaling up to $6,500. And keep in mind, I'm emphasizing up to. There is what's called a modified adjusted gross income allowance. So depending on what your income is on an annual basis will determine whether you can contribute up to the maximum the plan allows. So you want to make sure every year you're consulting with your tax professional to find out what's your modified adjusted gross income to ensure that you're not contributing what we consider adding funds in the form of an excess contribution, because there is a 6% penalty for the amount that exceeds the amount that you're allowed to contribute on that for that particular tax year. The Roth IRA, same contribution limits, same rules as the traditional IRA. The difference between the Roth and traditional is that the Roth grows tax-free. Any growth that you realize in the Roth plan after you've had the plan for at least 5 years and you are at least 59 and a half, you can pull out those proceeds without any tax and or penalty. So that's something that's really popular, because not knowing where we're going to be tax-wise over the next 10 or 15 years going into retirement, you want to know that you're growing your retirement account but not going to be pretty much hit over the head, so to speak, when you start to pull those funds out at a much, much higher tax rate down the road. So what some of our clients are doing is, because they can't afford to convert all or a portion of the funds, they will usually set up both, for example, a traditional and a Roth IRA, and they will partner these types of plans in different types of investment structures. So in addition to the annual contributions they're allowed, they can also realize the growth on these plans relative to the investment structure that they're choosing, and able to grow the plan in accordance to what percentage of ownership is owned by each plan. And I have some more information on it. If you have information or any questions relative to how to partner your different plans and the different structures and options, I'd be happy to take those calls or inquiries offline. The SEP IRA is for those who are 1099 or self-employed. It's a tax-deferred account, and usually if you're 1099 or self-employed, this is something that's real popular with real estate professionals, small businesses, sole proprietorships, and so on and so forth with no employees. You're able to contribute up to $52,000. Once again, it's based on a modified adjusted gross income. So if you're self-employed, you want to definitely sit down with your tax professional and make sure that you have earned income, because if you have a loss for that particular year and not showing any income, you're going to more likely be prohibited from making any form of a contribution. A simple IRA for those small or medium-sized businesses with 100 employees or less, you can contribute up to $12,000, also a self-directed plan. And finally, our 1K is also known as a solo K. It is usually a hybrid between, say, a SEP IRA and a 401K, and basically you are able to contribute up to $51,000. You have a Roth option, so for example, you're able to contribute as both an employer as well as an employee, as you see below. These are your contribution limits in both buckets, as both an employer as well as an employee. The Roth option would pertain to the employer contribution. If you were looking to opt to contribute up to $17,500 into a Roth, you can elect at that time when you set up the account that you want to make sure that your employee contribution is a Roth contribution. So one you make sure is as the $1,000 catch-up provisions applies to both the traditional and the Roth. So you want to make sure, once again, that you're consulting with your CPA and or tax professional before you make contributions into your plans. Other investment options and structures, we want to go through this real briefly, is if you wanted to partner via an LLC, this is whether you're purchasing real estate, investing in notes, you have a lot of different partnership options and structures that's available to you. Partnering via tenants in common is more or less relative to you. If you're purchasing real estate, you're able to combine retirement funds as well as personal funds. And non-recourse loan, this is if you're looking to purchase real estate and you're looking to use a form of leverage financing where the IRA or 401k is the borrower, you're able to obtain loans directly to your IRA and or 401k to basically make up any cash that you do not have in your retirement plan to acquire the property. The new deal exception, as I mentioned on the previous slide, usually you're prohibited from doing business with yourself or other disqualified parties. But there is an exception to the rule, meaning that as long as the asset being acquired is not owned currently by your IRA or your retirement plan and or yourself or your spouse, you can actually partner with those disqualified parties as long as there's no existing or previous ownership interest in the investment opportunity, and you're able to partner those funds to acquire that asset or make that investment. And what you want to do is make sure that you're aware that the percentage of ownership is determined by what each party contributes towards the acquisition of the investment or the asset to make sure that you're complying with IRS rules. I have an actual PDF on that. If you want more information on that, I'd be happy to get that over to you. Just send me an email and I'll send that over to you. And lastly, we got loaning money secured by deeds of trust. We had Dennis and Russell talk about that, so not going to go too much in detail about that, but once again, that is one of the options, and that is today's topic. So you definitely want to contact them to get more information on what their investment offering are and the structures they offer when it comes to real estate secured loans or some of their funds that they have available. To get your account established, you just want to get everything going, you want to basically establish your account. Like I said, you can actually establish an account online. There's a link that we usually will send out to you. It takes about 5 minutes. Scan and email your ID over to us. We can set up your account the same day. If you want to go the manual route, we can email you the PDF version of the application packet within 24 hours. We can get the account established. The funding options, as mentioned in the previous slides, so you want to transfer funds, roll over, or make a contribution. Those are your options that you have available to you to fund your retirement account for investment. Completing a direction of investments is one of our third-party, or should I say internal forms that's required by you as the investor or the account holder, authorizing us to disperse funds over to the investment. That is one of the forms that you would have to complete, along with a list of different third-party documents. If you're interested in finding out what's required relative to investing in a deed of trust or making a real estate loan, whether it be secured or unsecured, go ahead and send me an email and I'll send you a checklist relative to the investment option or structure that you're looking for. That way you have a clear and concise list of what's required as it relates to make that investment with a self-directed plan. So here's a visual, or should I say a flow chart, to kind of give you a visual aid in terms of how the process works. You open the account, fund the account, select your investment, and we fund the investment. Usually within 3 to 5 business days upon receipt of a complete investment package, usually we will disperse the funds via check or wire. You definitely want to make sure that all the forms are complete, as we do have to run everything through compliance to make sure everything is above board. So any documents or packets containing any errors will usually result in a delay and restarting the 3 to 5 day clock. So that's something that usually you want to make sure that you're paying attention to the checklist to make sure that when you submit the packet, everything is in order and we can get your transaction funded within a timely manner. So in summary, IRAs can hold all types of investments, not just securities. Partnerships and split ownerships are allowed, so you do have options when it comes to using both personal funds as well as retirement funds in a partnership structure. IRAs and solo K plans can grow tax-deferred or tax-free. You want to check with your tax professional and kind of get an idea of what's best for you, and not something that maybe your friends or relatives are doing. You want to look at your case on, with your specific situation in a case-by-case scenario, and have that conversation with your tax professional in terms of what's best for you. All plans qualify for partial transfers and or conversions. You definitely want to, once again, look at your investment portfolio as well as to look at your tax situation to determine what's best for you. before you enter into any type of investment, you must have what's called a legal retirement account vesting. So it's important that you have the account at least set up, not necessarily funded, but at least set up in order to enter any type of contract. You have some transactions to where it's common in real estate to where they'll go out and enter in a contract under their name, assuming that they can transfer the title or the contract from their name personally to the retirement account. That is considered a prohibited transaction, so you definitely do not want to go that route. So here's my contact information. If you have any questions, feel free to give me a call. So at this point, we're going to open it up for our Q&A session. And Dennis and Russell, if you're still on the line, let's go ahead and start taking some questions.
Yep, we're here.
Okay. Well, it looks like one of the first questions here is you mentioned that it was $25,000 minimum investment. Usually, are they able to, this question is basically asking, are they able to use both personal funds as well as retirement funds? And what would that basically look like if they were to looking to use both personal as well as retirement funds in one of your investments?
Well, we would actually set up, if they wanted to do both, we'd have to set up two different accounts. There would be an IRA account, and then there would be an individual investor account. So the broad answer to that question is yes, we can take, direct funds just right out of a checking account or what have you, and or we can take IRA funds. So you would have two separate accounts.
Okay, and the next question here is asking relative to risk. As it relates to your funds, it's basically asking what are the downfalls or perceived downfalls by investing through a fund versus having a direct interest in a particular property on just say one note or a promissory note or deed of trust?
Well, I think if you invest in an individual deed of trust, essentially what you have is all your eggs in one basket. Okay, so that's the difference between a pool or a bond or something like that, where you have multiple loans and multiple borrowers that are involved in securing the transaction plus generating the income. So since you have all your eggs in one basket on an individual deed of trust, it should generate a higher rate of return, but it also, if something goes wrong, you can lose, a significant amount of your investment, or lose some of the income associated with that investment. So that's basically the deal. It's diversification versus something that's not diversified. So if you are going to invest in individual deed of trust, then you probably better be a pretty astute real estate investor.
And question, actually, this is one of my questions. Usually it's a common question that I get, and I'll just kind of put it out there for the audience, is that usually if they're looking to invest via a fund, what type of transparency do they have relative to the different types of properties that the fund is invested in? And I know some of the organizations that I work with, they have a website for all the members to be able to log on to basically take a look at the different properties that the fund owns as it relates to the trust deeds. Is that something you guys offer as well?
Yes, I mean, obviously we have a website and so on, but again, it depends upon the structure of the entity. I mean, in terms of the transactions that we put together, if it's a fund or a debenture or something, the issuer or the LLC would have audited financials, and that creates, if you can get to an entity that has audited financials, then you should have a lot of transparency because that's what that's all about. If the pool doesn't have audited financials, then it becomes one of those deals where you need to kind of look at each individual deed of trust and so on.
So as an aside, Capital Alliance is one of those companies that does have audited financials as opposed to the others. So I just want to make that clear, Lamar.
Yeah, and that was the next question I was going to ask, because I think that's usually one of the missing components to where when losses are sustained is that they do not have audited financials, and especially if it's a situation where you're investing in a fund, you want to make sure, because you do not have any form of collateral, so to speak, is that fund does have audited financials. So that is a good point that you brought up.
And remember this also, I just want to sort of change the rheostat there about it having collateral. Remember that deeds of trust are a very unique investment because it's one of the very few investments out there that is actually secured by a real asset that can be touched and smelt and felt and seen. Whereas, if you buy stock in, for instance, IBM, if something went wrong with IBM, you couldn't go to the warehouse and pick up 50 computers to pay yourself back. But with real estate trust deed investing, you have a real asset that, if need be, can be liquidated to pay yourself back, which makes it a very unique investment opportunity. And given double-digit returns or close to those for a secured investment, it's not a bad route to take.
And the important part too is that the borrower, has a lot of skin in the game. If we're lending at 65 or 70% or 75% loan to value, that means that the borrower has got 35 to 25% of his own money in the transaction. So that, again, is unlike a lot of investments where, really there's no skin in the game, so to speak, the way they're structured.
Mm-hmm.
Another question I was going to ask, and I know I work with several other funds out there that some of my clients will come over as a result of referrals and whatever the case may be. They are offered a guaranteed return, and that really depends on the structures. I know some of them on an average are usually getting an average guaranteed return of 8%, but those usually are through the funds. Do you guys offer any type of guaranteed return for those who are looking to go that route?
When you say guaranteed return, guaranteed by whom?
Usually by the fund. So, for example, if they're guaranteeing 8%, and if they're basically going out and lending it at 12% and making their money on points, their investors are guaranteed a fixed rate of return of 8%.
Well, again, in terms of the options we have, if you go the mortgage bond route, that is a specified rate of return.
Fixed return, 6%.
Fixed return.
Okay, so maybe
I hesitate to use the word guaranteed because there's very few things guaranteed in this life, but
that's true.
Ours is a specified rate of return, and there's a separate bond instrument that the investor holds that spells out the terms of that.
Okay. Looks like this question here is relative to the information I had covered, talking about the New Deal exception, and I'll cover this briefly. It's basically asking, as it relates to partnering husbands and wives, what are the restrictions? Only restriction, as I mentioned earlier, is that making sure that the asset that's going to be partnered on is not owned by either the husband or the wife. It is actually, when we say New Deal, meaning a new transaction, and the percentage of ownership between the two parties or the two IRAs or combination of the above is usually determined by the amount of acquisition of the asset. So, for example, if it's 60-40 split between a husband and wife IRA, 60% by the husband, 40% by the wife, all income and expenses must be split in accordance to the percentage of ownership within that actual held asset. So throughout the duration of that, the plans are holding that investment, all income and expenses must be split 60-40. And the percentage, there's no rules in terms of what the percentages have to be. It's always determined by what the acquisition percentage or the amount of monies contributed into the actual investment that's going to determine the percentage of ownership. You want to make sure that is something that you're going to be able to follow, because you don't want a situation where it's not just say if it's a sister. Usually a sister is not considered a disqualified party, but you want to make sure that the percentage of ownership rules are followed, because you would have to actually sell the entire asset in order to come out of it. You couldn't sell your portion of the interest of the ownership to the other party or vice versa. You'd actually sell the actual asset, take your respective percentage of profits, and go your separate ways. So before going that route, you definitely want to make sure that you're in it for the duration of whatever that term of that investment is. Next question here. I think this is relative to what you guys had covered as well. And you said the minimum investment is $25,000. So I'm reading this here correct here. And they didn't specify as to which investment structures. Can you elaborate again on both the minimum for both, or at least a range for the fund as well as for the actual deed of trust investment? Well,
again, Lamar, typically the deed and trust investments, just think about this. If you just think about your own house in California, depending upon where you are, your first trust deed is generally going to be, $300,000, $400,000, $500,000. So the way most investors would invest in the individual trust deed is in what they call a fractionalized interest. Maybe you own 20% of a $500,000 first trust deed. That would be equivalent to $100,000. The advantage of funds or bonds is you can have a $25,000 minimum, let's say, and you can add to it typically by increments of 1,000. So you have a lot more flexibility in terms of the investment amount.
Well, next question also, and it's probably something that probably give people a little clarity, because you have some family members who may want to partner but not necessarily partner with someone they're not familiar with. Are you guys able to help them identify an investment structure to where maybe 4 or 5 family members to come together in a fractionalized ownership position on one of these deeds of trust?
Yes, I mean, that's what we do. I mean, you can typically have up to 10 different owners of an individual deed of trust. Okay. So, even if it's a, $500,000 deal, you might be able to get, 7 or 8 different investors involved. And it's something that we can do. We can counsel somebody if, depending upon, we know, the availability of money and the timing, we can put something together. We also have a pool of existing deeds of trust that we could sell interest in as well. So, I mean, there's a lot of flexibility there.
Okay. And one last question, and this is actually my question, relative to loan servicing, just kind of give them a little clarity on that. If they were looking to invest in a deed of trust, would you guys handle the loan servicing as relates, or would there something, an added service they would have to do?
No, absolutely. We do handle loan servicing. We service all our own loans because, we want to make sure that they get serviced properly and that the borrowers are paying on time. And typically the charge for that, depending upon who you go to, is between 0.5% and 1% a year of the loan amount to service a loan like that. And we would also generate the 1099s for the borrowers and collect the payments and make the disperse the payments to the individual investors.
Okay, perfect. Okay, well, it looks like those are all the questions that we have. Any questions that we did not answer during this segment, feel free to give us a call and or email us. I will be making sure that the playback link of this PowerPoint or this webinar presentation is sent out within the next 2 to 3 business days. For those who weren't able to listen to the webinar in its entirety, you will be getting, like I say, a full playback link of the actual webinar. And we would like to urge you to go ahead and share that with others who were not able to attend the webinar. Like I said, if you have any questions, feel free to give us a call or email us, and we'll be happy to answer any questions. Dennis and Russell, I'd like to thank both of you guys. Great amount of information that you guys have covered. This is, once again, one of those hot, sought-after topics as it relates to real estate investing, because as I mentioned earlier, not everyone has the time and or the expertise to invest in real estate, and this is definitely one of the more passive methods of investing in real estate. So with that being said, thank you everyone for attending, and you have a great day.
Thank you.